Most investors never get ahead because they make the same costly mistakes. They panic sell, chase hype, and fail to build real wealth. And the worst part, they don't even realize they're doing it. I've spent years studying the world's best investors, people like Warren Buffett, and applying those lessons to my own portfolio. Over time, I've learned exactly what separates the top 1% of investors from everyone else. And today, I'm going to break it all down for you. In this video, I'll show you the 6 key investing principles that the top 1% follow and that 99% of investors ignore. If you apply these, you'll be miles ahead of the average investor and on your way to real financial freedom. Stick around because this could completely change your financial future. Most investors don't do real research. They buy stocks because they heard about them on YouTube, saw them trending online, or someone at work mentioned them. This is why so many fail. Warren Buffett reads hundreds of pages of annual reports before making an investment. He doesn't guess, he knows what he's buying. He once said, risk comes from not knowing what you're doing. If you put in the work, reading financial statements, studying company fundamentals, and understanding the long-term vision, you will be in the top 1% of investors simply because so few people actually do this. Want to get ahead of 99% of investors? Know what you own and know why you own it. Patience is one of the most underrated investing skills. Most people jump in and out of stocks chasing the next big thing or panicking at the first sign of trouble. But the best investors do the opposite. Warren Buffett famously said, "Our favorite holding period is forever." Right now, we're seeing a market correction, and this is where most investors fail. When stocks drop, the average investor panics and sells, locking in losses. They let fear dictate their decisions, fearing the market will fall even further. But history tells us this is a mistake. The market has always recovered, and those who stay invested end up outperforming those who sell out of fear. The top 1% of investors stay calm. They don't let fear or greed dictate their actions. Buffett puts it simply: be fearful when others are greedy and greedy when others are fearful. This is why emotional discipline is just as important as patience. The stock market is designed to test your emotions. It swings up and down, fueled by headlines, economic uncertainty, and investor psychology. Most investors panic sell when the market crashes and chase hype when stocks are soaring. This is exactly how wealth is destroyed. If you want to be in the top 1% of investors, you must learn to ignore the noise, tune out the panic, and stay focused on the long term. The market rewards discipline, not emotional reactions. If you stay patient, you'll outperform 99% of investors who can't. For most investors, Buffett recommends simply buying an S&P 500 ETF like VU, and for good reason. It gives instant diversification, is low cost, and historically outperforms most active investors over time. However, Buffett himself didn't build his wealth through index funds. He built it by owning a concentrated portfolio of great businesses like Apple, Coca-Cola, and American Express. If you want to be in the top 1% of investors, you should consider balancing your portfolio, owning ETFs as your foundation, while using a portion of your portfolio for individual stocks that have the potential to outperform. The key is only buying great companies at fair or undervalued prices. This is where most investors go wrong. They chase stocks at their peaks, buying into the hype. The best investors wait for opportunities. Market corrections, recessions, and general turbulence create buying opportunities where great businesses temporarily trade at fair or even bargain prices. Look at 2008, 2020, and even right now. When the market falls, many incredible companies become undervalued. This is when smart investors step in and buy while the rest panic and sell. If you want to outperform 99% of investors, you need a plan. Whether you choose VU for broad market exposure or handpick great individual stocks, focus on quality and price, not hype. Trying to time the market is one of the biggest mistakes investors make. No one, not even Buffett, can predict exactly when the market will hit the top or the bottom. But here's the truth: you don't need to. Instead of waiting for the perfect time to buy, the smartest investors focus on time in the market because that's what builds wealth. That doesn't mean you shouldn't recognize great opportunities. The best investors buy when stocks are undervalued, but they don't wait for the absolute bottom because you'll never know when that is. The data is clear. Those who invest consistently, even through crashes, end up ahead of those who try to jump in and out. Start now, stay invested, and let the market work for you. The best investors never stop learning. Warren Buffett famously spends 80% of his day reading, analyzing financial reports, studying markets, and learning from history. He said, "The more you learn, the more you earn." And here's the reality, even the best investors make mistakes. What separates the top 1% is they analyze their mistakes, adapt their strategies, and move forward smarter. Buffett himself has made huge investing mistakes, but instead of ignoring them, he studied them and adapts. He once said the most important thing to do if you find yourself in a hole is to stop digging. If you're not learning and improving, you're losing. The best investors always have cash on hand, not because they're afraid to invest, but because they're waiting for the right moment. When the market crashes and stocks go on sale, most investors panic, but the smartest investors are prepared. They buy when others are fearful and scoop up undervalued assets at bargain prices. Warren Buffett famously keeps billions in cash for this exact reason. Another great Buffett quote, "The stock market is a device for transferring money from the impatient to the patient." A cash reserve isn't just safety, it's firepower. The difference between average investors and the top 1% isn't luck, it's discipline, knowledge, and strategy. If you want to get ahead of 99% of investors, follow these key principles. Do the research, know what you own and why. Stay patient, let compound interest work in your favor. Invest in what you understand, avoid hype, and stick to businesses you believe in. Focus on quality over quantity. Own great companies at fair prices, not just any stock. Control your emotions, ignore panic, and stay focused on your long-term plan. Diversify smartly, don't overcomplicate your portfolio. Keep investing, don't try to time the market. Time in the market is what builds wealth. Have cash reserves, be ready to buy when opportunities arise, and keep learning and improving, adapt to new information, and never stop growing. Most investors ignore these principles, that's why they will never reach the top. But if you apply them, you'll be miles ahead of the majority and on your way to financial success. I really appreciate you watching. If you're not sure what to watch next, check out this video right here. I think you'll really enjoy it. Take care, and I will see you next time.